Hi, my name is Sani Hamid and I'm the Director for Economy and Market Strategy here at Financial Alliance. Today I'll talk to you about what we consider to be the market's reaction to COVID-19 and how we believe that the market is really underestimating for a second time the risks that COVID-19 is exhibiting. This episode is actually broken up into two. It's a bit long, so there will be a part one and a part two, and I hope you can also join us in the part two. We'll start off by saying that it's been quite a volatile period, as we all know. The markets have actually moved up in quite volatile fashion, with the Dow Jones up 1,000 points on certain sessions. Last night on Thursday, it was down by almost 1,000 points, 900 over points. A lot of the news that we see, basically, and I'll just call up the print pointer here. Hang on. A lot of the news that we see either relate to the market or to COVID-19, and really it's quite a noisy situation. So what I'm going to try and do in this next few sessions, or at least next few slides, is to try and give you an idea of how we see the markets, how we interpret what we call the market reaction, whether it's discounted enough of the risk of COVID-19, and therefore what to expect going ahead in the weeks and maybe even in the months ahead. To give you the big picture of our view, over the short term, which we consider to be roughly about 3 months, we think that the initial downturn, the first underestimation by the market, has really occurred. This was when actually COVID-19 was actually spreading in China. A lot of people outside of China was either saying it's not going to go out of China, we are safe, and even if it does, it's very much like SARS, and therefore it's going to have very limited impact. From what we saw back then was the total opposite. We expected it to spread out of China, and also in a manner not like SARS but more like H1N1 or even the seasonal influenza, and that told us that the spread would be quite extensive. And when we saw markets going higher despite this fact, straight away we knew that the market had underestimated this COVID-19 risk. And that's why I think 2 weeks ago the markets actually adjusted, and quite sharply, to these facts. Today we are in a situation where we call it intervention. We see Federal Reserve, Bank Negara, Australian central banks across the world cutting rates, and governments coming out with fiscal packages, the US, even the WHO, to try and mitigate the impact from COVID-19. So this has given markets some comfort, and that's why we see markets actually recovering and bouncing off the recent lows. However, going ahead, we think that the market continues to underestimate the risks from COVID-19, and that's what we're going to talk about in the next few slides. So therefore, we think that there is still another down leg in equity markets, which will take us lower in the next couple of weeks or even months, until we reach a stabilization point. Post COVID-19, don't get me wrong, COVID-19 will end, but what we fear is that it may just be the first domino, which could then topple other dominoes. Given the fact that the markets have been going up for the past 10 years, we are at the so-called end of the cycle, both in terms of the investment cycle and economic cycle. So I won't be surprised if COVID-19 is that first domino which topples many other dominoes, but this won't be covered during this session. We'll cover that in another session. Well, before we carry on, let me explain something called price behavior, why prices move higher and why prices move lower. It's got a lot to do with expectations and actual outcomes. I think the best way to explain this is via an example, and let me give you the example and you understand what I'm trying to say. Let's say, for example, GDP comes out at 10%. Okay, a 10% GDP is very high, so it's considered to be very good. However, not really the case in terms of price action. How the market reacts to a GDP of 10% really depends on how much the market has discounted. So if the market has discounted a 10% GDP in the first place, what you'll find is that market prices won't go anywhere in reaction to the actual release of 10%, because it's discounted what is actually being released. But if the market had discounted a 15% GDP, had expected a 15% GDP, and yet it only came out at 10, what you see is you'll see prices come off because the markets had discounted much more, a higher GDP, so to say. Okay, and was disappointed by the fact it only came in at 10 and therefore had to adjust lower. And similarly, if the market had discounted a much lower GDP of 5%, and when the actual one comes out at 10, you'll find that the market is quite happy with it, and therefore prices will actually adjust higher because the actual GDP comes in much higher than what was expected. Okay. Why am I saying this? Because when we try and understand how prices may move over the next couple of weeks and months with regards to COVID-19, it's really based on this model. One good example is at the beginning of this year in February, when I released this report. The report was actually titled Shutdown Risk. As I mentioned earlier, we were seeing risks coming out from COVID-19, risks that the markets had failed to see. Markets were thinking it's more like SARS, but actually it turns out to be more like H1N1. Markets were thinking that it's going to be confined to China. We thought that actually no, with this kind of characteristics, COVID-19 would actually spread to the rest of the world. And when those two facts became known, the markets actually adjusted because they had initially underestimated the risk. Okay, so today, what we need to do is we need to anchor what's a so-called scenario with regards to COVID-19, which we think is the most likely scenario, and then ask ourselves, has the market discounted enough of the risk associated with this scenario? Of course, if the market has underestimated the risk, therefore, meaning to say it has actually not gone down enough, then what will happen is as these risks emerge, the markets will start to adjust lower. And vice versa, if the market has overcompensated for that risk, meaning to say it expects a worst case scenario but turns out it's not, then of course the markets will adjust higher. So that's really the way we would want to assess how markets are going to move going ahead with respect to COVID-19. In our view, and I will evidence this, or at least I will explain this in the slides ahead, is we think that the markets currently underestimate the risk of COVID-19, and there is a likelihood that the markets will adjust lower as the risks become apparent, and the markets then start to price in at that point those risks. The first thing that we think markets have really underestimated is the demand side, or the impact of COVID-19 on the demand side, which is basically the consumer. As the consumer sees things like increased number of cases of COVID-19, increased number of people going to the hospitals being overwhelmed, all these things will have a psychological impact on the consumer in terms of spending. It could even be the fact that the consumer himself or herself in the office is closed down, there are quarantines, colleagues are sick, the spread is within the office. So all these things, really, the consumer, him or herself, will then start to back off in terms of consumption, and that has implications on economic activity. So let's look a little bit in terms of what are the likely scenarios first that will cause what I've just said. In Singapore itself, in Channel News Asia, one of the reports that I found is quite interesting in the sense that it outlined the three scenarios, potential scenarios for COVID-19. Note that many academicians, many scientists who are trying to model COVID-19, break up the scenarios into three: a minor scenario, okay, best case, a moderate scenario, base case, and what we call a severe scenario, which is the worst case. Right now, the moderate case, or rather the minor case, or the best case, is actually a case whereby the virus is brought under control, containment is successful, and so on. This actually increasingly is no longer the case. As we can see from outside of Singapore, the containment has failed. Countries are moving to mitigation because the virus is now spreading within the community. So it's safe to say that we are many countries, including Singapore, which will eventually move away from what we call containment to what we call mitigation. So this scenario is highly unlikely to remain and is a very low probability scenario. Another low probability scenario but a very high impact scenario is scenario 3, which is the most severe scenario, whereby the virus itself probably spreads in a virulent manner, killing many people across the world. Singapore moves to DORSCON red, and in this particular report even says that there potentially could be thousands dead in Singapore and millions worldwide because of the virus. So this is really a high impact, low probability scenario at this particular point. We're not saying it can't happen, but we attribute a very low probability of it happening at this point. We attribute a higher probability and most likely probability to the second scenario, which is what we call the baseline scenario. The baseline scenario is whereby clusters start to move within communities, moves within communities. There's no link back to China and so on and so forth. You'll find that many people fall sick, the hospitals are being swamped, and business activity slows down. So it's not as bad as scenario 3, but it's worse than scenario 1. And we think that this scenario basically is the one that the world will experience over the next 2-3 months. It is basically a scenario which more and more scientists, doctors, modelers are looking at as the baseline scenario for the world. This scenario is basically a move away from containment, what is called containment, trying to contain the virus, to accepting the fact that the virus cannot be contained, so therefore to try and mitigate the impact or severity of the virus. In Singapore itself, the government also has started to highlight this. The latest headlines coming out is prepare for significant increase, and basically it is actually a realistic scenario to say that you can't really ban people from coming in, because you can do so for one country. But now, since it's spread to Korea, Italy, the US, Britain, Europe, Australia, New Zealand, there's really very little that you can do to contain it. And so Singapore itself, which is one of the best models in terms of containment, may also eventually move to mitigation. So what we have seen so far is this. COVID-19 has spread in China. This is called an epidemic curve. The number of cases that we saw in China rose and peaked in early February and started to come off. Well, the thing is this, for the rest of the world where the virus spread thereafter at a later stage, the number or aggregate of daily cases are just beginning to rise. And this will continue, because if we look back into what we call, for example, the epidemic curve of SARS, you'll find that there was an initial move higher, which is A, followed by the second wave, which is B, so to say. The initial move was actually from the country of origin, and B is where actually the virus spreads in other countries or throughout the world. So if you apply back the same chart which I showed you earlier, the initial country of origin for COVID-19 is of course China, and China has finished its epidemic curve, so to say. But the next one to move higher would actually be that of the rest of the world. How many people in the world will be infected really is still a big question mark. In H1N1, about 1 in every 5 people was infected globally. There are indications, or there are studies which says that maybe up to 60 or even 70% of the world population could be infected with regards to COVID-19. So basically, by and large, what we will see over the next couple of weeks and months is a spike up in terms of cases in the rest of the world. May it be in the US, UK, Europe, and many other countries. And what we will see is the epidemic curve for the world in aggregate rise up. Of course, different countries will have their own epidemic curve, but in aggregate, you will see a sharp increase in the numbers. This is one thing which, in terms of demand, you will find that it will impact consumer demand. I mean, the consumer is going to feel fearful when he or she looks at the number of cases which continues to rise day in, day out, day in, day out. I mean, that's going to have a psychological impact on the consumer. What governments worldwide are going to try and do is to flatten the so-called epidemic curve. When I talk about this, basically what I mean is, without any form of mitigation, you will find that the epidemic curve goes in this red line manner or red area. It is very tall or very high. What it means is a lot of people get sick at the same time. What countries try to do is implement measures to bring down that peak and flatten the curve in a manner like the curve below at number 3. This is important because if you compare the first curve and the second curve with intervention, the second curve is much lower in terms of its peak, and therefore you find that the number of people falling sick are not as many in any certain period of time. Whereas in the first instance, without intervention, you find that a lot of people fall sick within a very short period of time. Meaning to say, in that one particular week, you have a very high number of cases in the first instance. In the second instance, it's lower. And this is very important because what it does, it actually means that there's less people going to seek medical attention in the second scenario compared to the first scenario. The first scenario, actually, we saw it in Wuhan when the virus first came out. No one really knew what to do. There wasn't many intervention or even mitigation that was done. So a lot of people fell sick at the same time. A lot of people went to the hospitals. The hospitals were overwhelmed. Even now, with the measures being taken, you still find the situation cropping up in countries which have the virus in terms of spreading widely within the community. In South Korea, we have news about hospitals running out of beds. Similarly in Italy, and we have warnings from people in the UK that the NHS isn't ready yet, and even in Australia and many parts of the world. So this is really what the authorities are worried about, which is a sudden increase in the number of people sick, seeking treatment in hospitals. And again, this will have an impact, we believe, on the consumer. One is he or she will be afraid of being infected, even though the possibility of it may be 1 in 5, 20% chance of it happening. But again, you can't tell. You're afraid. You won't spend. You won't go on your holidays. You won't do this. You won't do that. Again, you will curtail your consumption, and that would impact demand. So the problem with COVID-19, as we've always said, is not about mortality. Mortality as a percentage is low. In terms of numbers, mortality may look large at the end of the day, but in terms of percentage, it's going to be low. The main problem with COVID-19 is actually the number of people who fall sick and the stresses on the various countries' healthcare infrastructure. I'll try and explain a little bit about that. These numbers are widely accepted numbers, which means that the scientists and the doctors all agree to it. Roughly about 80% of people who are infected will only have very mild symptoms that will not need any form of hospitalization. However, about 15% of them will be severe and they need hospitalization. They will suffer from pneumonia, shortness of breath. And there are about 5% of people who will need ICU care. These are the people who suffer from organ failure, acute breathing difficulties, and so on. Yeah, so 20% of people basically will need to be hospitalized or need hospitalization in a sense. Let's put down all of this in numbers. For a population of 1 million, if we are talking about infection rate of 20%, and as I mentioned, could go as high as 60% in certain studies, but if we just take 20% as an infection rate, it means that 200,000 people will be infected in a population of 1 million. Out of the 200,000 people, 160,000 or 80% of them will only have mild symptoms which do not need hospitalization. But 30,000 of them, or 15% of them, will have severe symptoms, will need to be in hospital, and another 5% or 10,000 will be in critical situation and need ICU level type of care. in itself, when you look at the numbers, that's 40,000 people out of a population of 1 million that need hospital care over a short period of time. So I think this is really what the authorities are worried about, and I think this is really something which the market hasn't really discounted. Because when we start seeing the hospitals being filled up, people thronging to the hospitals, there's not enough beds and stuff, it really sends a very strong negative psychological impact to everybody else. So everybody else will be scared of being infected. The fact of the matter is, while studies show that people who are older, people who have comorbidities or existing illnesses are more likely to be in this 20%, there's no saying, because this is a virus that's going through the system for the very first time. I'm happy when it comes to influenza. I've suffered influenza before, which is the normal seasonal flu. I know how it feels. It can feel quite terrible, but I know I won't die from it, or at least I won't be hospitalized from it. But this particular virus itself, my body hasn't met it before. We haven't gone through it before. I don't know how my immune system will react to it. While statistically I'm not supposed to fall within the 20%, I can't say, because it's the first time. So these kind of things really, I think, will go through the minds of consumers, and consumers will actually step back and become very cautious about spending, going out, and so on. So this is again an impact on demand when you come to look at it. So in the next episode, we will talk about the supply side. So I think over the past few slides, we've been talking about how the jump in the number of infected, how the jump in the number of people going to hospitals, this will really have an impact on the consumer in terms of consumer spending. So in the next episode, we'll look at the supply side, and we'll even look at something called, is there any good news among all this news that we have today. If you like this episode, please do subscribe to our YouTube so that you'll be informed of future episodes as and when we do release them. And do join me in this part 2 of this episode, which is coming up soon. Thank you.